Hello, everyone. I'm John Netto. We will be getting started in 3 or 4 minutes from now, but I want to take this opportunity to just sort of introduce myself as you guys filter in. Um, Quite excited about today's presentation. This is a bit of a new frontier for me, and I'll get into that a little bit more at 11:15 or at a quarter after the hour, wherever you are in this magnificent planet of ours. I As a practical matter, the way this is constructed, I cannot see the chat right now. And maybe Mark, you can help me with this, or someone can help me with this. And if someone does have a question during the course of
Yeah,
the presentation, you can note that to me. Like, don't worry, just like stop me and say, "Hey, Neto, there's a question in the chat room," because when I'm sharing the screen in the presentation, it limits that a little bit in terms of my ability to see those
sure.
things. So that'd be pretty
Absolutely.
awesome.
Yep.
Yeah,
I'll shoot that off to you in a private chat there.
perfect. We got it. We got it. Yeah, so welcome everyone. Hope you guys are if you are in a part of the country that's experiencing intense snow, I hope you're staying warm. If you are not in a part of the country that's not experiencing intense snow or part of the world, then I also hope you're staying warm. Yeah, but I'm fired up. We'll get this thing going in a couple of minutes here. Want to thank the Money Show and Mark for being here today to help me navigate this. And this is the first time I have presented on this subject. Done many things for Money Show over the last 20 years. It's been 20 years, Mark, which is kind of unbelievable.
Oh wow, yep.
So I'm excited about that. All sorts of variety of topics. And I would say that this topic today is a nice synthesis of 20 years of presentations for Money Show. And I look forward to sharing with everyone what how this plays out.
Excellent. Well, we appreciate you being here. And to all of those logging on, thank you so much for joining us as well. We'll be kicking off here momentarily.
I'm going to grab my water and be right back in 60 seconds.
Sounds good.
Whew. All right. Mark, it's at
All
on my
right.
clock. I see 8:14. Let me why don't you
Yeah, let's
get
go
us
ahead
going,
and
brother?
get it going here. Welcome, everyone. We are pleased to welcome John Netto. He's a chief legal macro strategist at Rearview Capital and founder and managing attorney of of Risk Legal Advisors, earning his Juris Doctor magna cum laude from UNLV's Boyd School of Law, where he externed with the Nevada Supreme Court and Discovery Commission. He's the creator of the Juris Macro Investment Framework. This framework extends the interdisciplinary work John has developed over 25-year career in global macro trading and risk architecture. He's also the author of the Global Macro Edge, Maximizing Return of Unit of Risk, and is featured in Jack Swagger's Unknown Market Wizards, the best traders you've never heard of. He created the Netto number, the risk factor compensation system, and protein strategy frameworks that have reshaped how professional investors quantify and reward risk adjusted performance. John, thanks so much for taking the time out. It's all yours.
Mark, thank you, brother. It's good to be here. Yeah, welcome everyone. I hope you're having a great day. Like we said in the prelude, building up to this, I have been speaking for Money Show for 20 years now, and going back to 2006. I want to thank Kim and the rest of the Money Show crew for providing this forum and venue for that. So that's been awesome. Today, I'm talking about identifying alpha and loss contingency disclosures and financial reports, and this is a subject really grown into in the last 5 months, this subject in particular, but as a broader measure, I've been trading earnings and events for close to 20 years now. But this nuanced component is what I'm going to dive into a little bit more, and I'm excited about that. Mark touched on a little bit, but just sort of about me. So I've been a derivatives cross asset class trader for the last 25 years, really over 2 decades. I wrote the Global Macro Edge. I was featuring Jack Schwager's book. You may also know that I was in the Marine Corps for 9 years, right out of high school after running a gambling operation in high school. I would provide liquidity for those wishing to prognosticate on the outcome of sporting events. So I was a market maker for sports betting in high school, and that did not lend itself to very good grades. So I ended up joining the Marine Corps. I am now currently the chief legal macro strategist at Review Capital, that is an SEC registered investment advisor firm, uh, headed by Neil Azus, who is truly one of the great thought leaders in our industry. Neil Azus was also a contributing author to the Global Macro Edge. What's now 10 years ago? The book came out 10 years ago. Pretty hard to believe. A decade has passed since that happened. I also, as Mark mentioned at the outset of my bio, am the founder, managing attorney of Unit of Risk Legal Advisors, which is a law firm I founded in 2025 after I passed the Nevada bar and earned my Juris Doctor. Based in Las Vegas. So for any of you come out to Las Vegas, give me a shout. Would love to sync up and go from there. As you can imagine, this presentation actually crosses three planes. It touches on a trading and investment advice or investment content. It also touches on legal content, and it's even going to delve into accounting as well. Well, two of those three at least require a disclosure. So this presentation, it's worth saying that this does not constitute legal advice, tax advice, accounting advice, or investment advice, and absolutely no attorney-client relationship is being formed from this presentation. Nothing discussed should be construed as recommendation, and accordingly, please read through this disclosure accordingly. All right, the goals of my presentation today, right? I really want to help you guys understand the framework for contingency loss reporting by companies. This is something that happens over their 10Q and 10K filings, which I'll delve into. And also want you to get an understanding of potential market reactions to litigation and regulatory results. Now, I'm going to focus today on specific litigation results at the company level, but there's a broader play here, which I hope to present for Money Show in the future on Juris Macro investment themes, large, broader legal themes, Supreme Court rulings, regulatory actions, et cetera, that impact a range of companies at a broader macro level. And then ultimately, this presentation, as you both explicitly and implicitly, is by the integration of law, trade, and financial accounting. And this can play towards the CPAs in the audience out there. This can play to the traders in the audience out there. This can play to the legal and the attorneys in the audience out there. And all three, really. I mean, most of this is a trading investor audience, but when you see the cross-pollination of all three disciplines, it's pretty fascinating stuff. All right, so let's get going. Let's lay a little bit of foundation here. All right, when we talk about loss contingency reporting, I and before I kind of walk out on you with some a little bit dry statutory or rules based reflection, understand where I'm coming from as a 25 year trader. Okay, the global macro edge, maximizing return per unit of risk, is about quantifying and identifying strategies or skill sets that can risk a little to make a lot. All right. And so when I created the netto number, I wanted to measure that because when you look at how people talk about performance, okay, performance is I made 10% last year, I made 20% last year, I made 50% last year. And that's what I would call one-dimensional performance. You simply understand the nominal return. Two-dimension performance takes that return and measures that against volatility. All right, I made 20%, but I had an annual vol of 30%, or I made 20%, but I was down 40% on my account at one point in time. All right, so that gives further context. And then the three-dimensional analysis, which is where the netter number comes in, and I've presented on this subject many times in the past, comes into where you have um, performance, but measured against an ex ante or before the fact or a predetermined risk budget. All right, so if I say you have a $100,000 account, if it falls by 20,000 to 80K, I'm going to pull the money. And knowing that I have that $20,000 risk budget, and this is how most prop traders work, this is how most of you here today, when you take on short-term trades, you have that predefined risk budget. So the netto number measures the performance relative to the predefined risk budget. The smaller the predefined risk budget relative to the performance, the better performance will be. So if you have 100K and you have a $20,000 risk budget, meaning the account can fall to $80,000 in total, and you make, let's say, 200,000, you make 100,000, you double the account for the year. We'll make it 100,000 with a $20,000 risk budget, and also depend on that volatility is a real three-dimensional analysis. The number explains that. I say that right now because when we're looking for strategies, we're looking for situations where we have asymmetries or anomalous market patterns that can produce outsized returns relative to the amount we're risking. So with that, let's start with accounting standards codification 450. And what is that? The accounting standards codification is a comprehensive organizational framework for GAAP. GAAP is generally accepted accounting principles, and this is what firms, accountants, CPAs lean on when it comes to guiding how they have to report and do their financial statements. All right. So in this framework, ASC 450, and it's much more than 450. There's, I think, eight or different nine subject sets within accounting standards codification, but 450 specifically governs loss contingencies. And so I put a link up here for those of you out there that want to delve into that a little bit. Okay. All right. So 415 itself says, hey, listen, all right, when it comes to you reporting on your 10K or 10Q, all right, 10Q, there's really three categories here, all right, because, and let me just do a very brief reset, all right. When I talk about accrual accounting, I mean that even if the cash hasn't been paid yet, if the deed is done, we account for it. And GAAP requires that these companies all be on this accrual accounting metric so that it's not just what they've paid or what they've received, but if they've effectively or constructively earned that or constructively owe that, then you have to account for it. All right. So why is that important? Okay. It's important because if you have a loss contingency or you have this pending litigation going on right now, it's it's required based on ASC 450 that you have to bucket that into three possible categories. All right. In the first category, and I'll go over each of these categories in a little more detail, but the first one is this loss contingency that you have, can you estimate can you look at it and say, hey, listen, there's a certain percentage of chance or a better than 50% chance that we're gonna lose this? And if we are, can we estimate what that loss will be? Well, in that instance, you have to accrue or effectively realize that loss on that 10Q statement. Second category is it reasonably possible? Well, it's possible, but we're not really sure what the if we can estimate it, but there is a chance of this. So in that case, we have to disclose that on the 10Q. And then if something's remote and you make a good faith effort to determine the remoteness of it, or this isn't very likely, then there's no disclosure required at all. And if you want some more color, I have the link here. And everyone can, of course, email me at the end. You can get the deck from this. All right, so let's go into each one of these in a little more detail. All right. The big one here. All right, this is probable and reasonably estimable. All right. Probable means that the future event is likely to occur. It's a higher threshold than more likely than not, which is a standard which many of us are familiar with. Legal context was called preponderance of evidence standard. That preponderance standard means that if you're a feather more than 50%, technically speaking, that reaches the threshold of the preponderance standard. All right. Now, if it's probable, or if it is more likely than not, then when these criteria are satisfied, the company records that liability. So if, let's say, I think that we can accrue a $500,000 or a $10 million loss from this, then we're going to go ahead and accrue for that on our financial disclosure statement. But as you can imagine, all right, there's a lot of variables in that. So one, we have to you know determine that we can actually, yeah, but it's greater than 50%. And two, we can actually determine the loss. So if you can't estimate the loss, all right, then it'll fall into the second bucket. But if you can't estimate the loss, unless there's multiple estimates, and this is the real key here. Let's say I'm the attorney, all right, and I'm telling you, hey, listen, in this case, there's five outcomes I can see. I can see us losing $1 million, $3 million, $5 million, $8 million, and $10 million. All right. So I just gave you five estimates there. Well, according to ASC 450, what we put on, as long as those outcomes are of equal probability, at least in my good faith assessment, then I could just put the lowest estimate in there. All right. So that $1 million. So even though, and this is something that I've learned in the last 6 months, is I've go from trader to attorney to now being someone who's doing postgraduate work in accounting with an accounting focus and data modeling and econometrics at UNLV's part of UNLV's MBA program and working with CPA professors as I understand. So I'm like, there's no way when I learned, I'm like, wait a second, you mean to tell me that one of the four principles of accounting is conservatism? And you're saying that if I have four or five equally likely chances where I have a chance of losing 1 million is equally the same as 10 million, I only accrue for the 1 million, not the 10 million. That seems to fly right in the face of conservatism, which is one of the four principles of accounting. Like, yep, that's how FASB and accounting and ASC 450 work. I'm like, all right, well, I'm going to show you guys. I think that's a feature, not a bug in this. So the bottom line is even if I can estimate, and the estimates are reason or of the same magnitude, I only have to accrue for the lowest amount. That's enormous, but that's like one of these super nuances that is something that many of us don't appreciate. I've been in the market 25 years, and this is something that I just learned of in the last 6 months as I delve further into this stuff. So it's very interesting. Like category two, all right. If it's more than remote but not probable, meaning I would define remote as, let's say, sub 5%. Now they don't now ASC 450 doesn't put specific numbers on this in the codification, but we know from the case law and just from the practitioner's perspective, this is typically how this stuff works out. So category two is it's probable, or category two is that it's not remote, but possible. Okay, that should say actually, that's not say probable. Sorry, that's my mistake on the slide there. I'll fix that if you ask for the slides. Um, so in that case, you disclose it. The disclosure must describe the nature of the contingency and provide an estimate of the loss and explain why an estimate cannot be made. All right, and these footnote disclosures are important. And go from there. All right, and the last one is remote. This speaks for itself. If it's remote, you don't need to disclose it. And this is governed under 450 ASC 450-20-50-6. All good stuff. And although the category doesn't require disclosure, it can still become focal points in subsequent securities litigation if it's determined that, and I'll discuss this a little bit more, that contemporaneous to this disclosure that maybe you were in deep settlement discussions, maybe there was information that you had, because there's a lot of gamesmanship going on here, and we'll touch on that in a little bit. All right, so the case law around this kind of focuses on two types. And for this presentation, I'm gonna talk about two types. The first, as you can imagine, are regulatory enforcement actions. All right. So there's a case, SEC versus RPM International. And in this case, the court evaluated, there was a DOJ investigation about whether or not RPM had was faithful in its disclosures back in a 2013 or 2011, I believe it was, on their 10Q filing. And at the time that they had disclosed that the chance was remote, or that there was a possibility, they were actually in deep settlement discussions, and had a pretty good range and could estimate that both it was probable and reasonably estimable that they were going to have a big chunk, and they did not accrue for that in their 10Q filing, based on a contemporaneous knowledge. And you can just think about this from a game theory perspective. If I'm the other side, all right, and I'm watching your 10Q filings, of course I want to see the posture, the position that you take, because that's going to help me. I'm going to try and use that for settlement leverage. It's like, hey, listen, you've already had to accrue this, and you've already disclosed it to your investors. So we both know that you realize that you're bent over a barrel here, or you realize that we have leverage on you. And so as you think about the tension between this, you're a public company, you're an attorney now advising them on how you see the framework of this case taking shape, and overall what chance they have in this litigation. And based on ASC 450 rules, um, there are disclosure requirements around that. But at the same time, you're trying to, in good faith, not, at least superficially in good faith, not tip your posture to where you almost have a an outcome that creates itself. And so this is the tension and the balancing point. And I want you guys to understand this, that when it comes to litigation and loss contingency disclosures, it can be problematic for the side disclosing, because it can end up costing them more money potentially, because it gives the other side potential leverage around that. So I think that's interesting. So the first side, like I said, is the regulatory enforcement actions, and the second side are investor initiated civil actions. And again, when it comes to this, and this may be surprising again, there's a bit of a paradox here that I'm going to get to when we get to the application of this from at least potential strategies and how this could potentially be applied um, when one's investing. Okay. And so the first becomes, hey, listen, we had, Bank of America disclosures litigation. This is something that plays around, the contemporaneity of the disclosure. In other words, at the time, even though it turned out to be really bad for these companies, if they were acting at the time, because we all know that litigation can be, wild and unpredictable, but if they were acting in good faith at the time, ASC 450 is a shield to that. Even if they, choose the lowest estimate, or even if they don't accrue for anything, ASC 450, you can demonstrate in good faith at the time that you made those disclosures, it's going to protect you. And then we have tax related contingencies here as well. That's more governed by ASC 740, but it does make its way on occasion into an ASC 450 contingency reporting. But that's another presentation. All right. So let's talk briefly about how these disclosures are built. And and like I'm saying, this is something that I've appreciated further, having graduated from law school last year, having become a licensed attorney, and seeing this firsthand, and appreciating how this may play out. Listen, you come to me as your attorney, and I tell you, hey, listen, I spent 25 years on Wall Street. I've built my ultimate risk models. I'm probably more qualified than most counsel out there to quantify this risk. I'm given my finance background. And I can tell you that, like, you're sitting here at a 37% probability that you're going to end up paying something. There's, or even maybe an 80% probability you're going to be paying something, given that most cases don't even go all the way through trial. I think 98% of cases end up settling. So I find it interesting that in many cases, these firms can't accrue anything, given the preponderance of cases, given the vast majority of cases that end up just playing up settling and don't make it through all the way to that jury decision. I mean, it takes a long time to get through a jury verdict, like years and extensive expense, etc. So, but then also management plays a role, and then the auditor plays a role. So there's three prongs here: auditor review, management judgment over the substantive aspects of it, and then counsel's judgment as well. We also have attorney-client privileges invoked. Now, for those of you out there, I'm sure you know or understand, appreciate that when you speak to your attorney, if it's seeking legal advice, all right, those conversations are protected. The facts around those conversations are not, but the conversation you have with counsel are protected. And so, as you can imagine, disclosed on the footnote, the conversations that you have, or the thoughts that you have, or the legal strategy that you have, implicates attorney-client privilege as well. So there's a lot of delicate points that come up from this, and I just find this absolutely fascinating, given the trading, the legal, and the accounting side of this. They're all three intersect in a masterful, elegant manner under ASC 450. And and I believe there's some real market opportunities for those who do a little bit of homework and look to trade it. All right, so let's talk about a couple of cases here. So 2013, Johnson and Johnson, they had just as many of you are familiar with the talc powder litigation that arose from that. Um, they, they started being hit with lawsuits. These things took many years to develop. In 2018, in their 10K, actually, that's their annual report. They said that several cases were pending, prompted, and they put some pretty extensive footnotes in there. But they said, as you'll often find, this is almost right of ASC 450, they were unable to estimate the possible loss or range of loss beyond the amounts already accrued. Okay. Any rate, investors said, no, that's BS. They ended up filing a securities action in the District of New Jersey. But the court sided with J&J. And even though, the damage was more extensive, they said that given the uncertainties of litigation, that the accrual was in line with ASC 450, and they ended up ruling against the shareholders in that. All right, so let's take a step back here. All right, as we're coming down to 10 minutes left on this presentation. How does this impact high velocity volatility targeting trading strategies? Okay, and let's think about what I've just gone over, and I'll bring this all home for you guys because I've hit you with a lot in the last 20 minutes or so. Large cap stocks reasonably have ongoing litigation globally. All right. And 10K footnotes, I'm just being honest, in my experience, the 10K footnotes itself are rarely instructive. Now, there are some which can be, but for the most part, if you look through an Amazon 10Q filing, look at the most recent Amazon 10Q filing, and you do that by going to sec.gov, and in the upper right-hand section, Edgar, EDGAR, type in Amazon. It will then populate, look at 10Q. And normally item 6 or item 7 or item 8, that's in my experience where loss contingencies fall. They're very general. They talk about a range of litigation going on. They talk about the general uncertainty. They'll put out a general disclosure saying if this works adversely against us, we could see well outsized losses. And that kind of language, in almost all cases, really does the trick because 450 acts as a shield to accruing larger number. It acts as a shield because remember, if you have 3 or 4 different estimates and they're all of reasonable likelihood, then you can go with the lowest one. All right. And as long as you make a good faith effort, to on both the probability and estimability prong, then in all likelihood it's probably not going to get accrued. So what does that mean? It means that if these companies take a loss, their earnings have not accounted for it. All right. And so what we can end up seeing is, in my experience, are situations where you find these asymmetries where if the options are not priced correctly around these events, because of this accounting nuance and because of this legal nuance, because of all these factors, there's an opportunity to develop strategies around firms in imminent litigation. Okay. And by imminent litigation, I mean they're currently at trial. And I'm going to go into an example that I saw firsthand last year in July 2025 here shortly. So as we look at the accounting side, the legal side, the trading side, following firms that have ongoing litigation, especially something material, knowing that from an accrual standpoint, in all likelihood, they're probably, and I emphasize probably, this is where you have to read the footnotes and to get a better sense, or go read the transcripts of the conference call. All right, it's almost certain that one of the Wall Street analysts is going to ask them, okay, walk us through how you've accrued for this litigation. Okay, and that can give you the sense of it. So it does require some work, all right, but I believe there's some opportunity with that work. All right. Um, so I talked about so now I'll say this: with large cap stocks, it's less likely to see a broad accrual or to see an accrual that notices that. However, on mid cap stocks or even potentially small cap stocks, the more prominent bright line litigation will make its way into those footnote disclosures, which can give you a better sense of just how much accrual has taken place. But even in those regards, given ASC 450 standards, it's something that can be, is in all likelihood, in my experience, is going to be more conservative, meaning that they're going to actually use the lower number for accrual. But again, that's where you got to find out. All right. But keep that in mind as well. And then options chain availability is a consideration as well. Now we know that especially with the bigger stocks that we're now seeing options expiries on Monday, Wednesday, and Friday on the S&P 500 futures and many futures, gold, silver futures, daily options on those guys. So some stocks only have weekly options, others still only have monthly option expiration. So follow those option chains as a way to really spot the volatility around this pending litigation. And you can look at it, I know from my years of trading options and still following the volatility curves on these options markets, that we can compare or regress implied option volatility for the front month where maybe this litigation is going to be, or maybe a jury decision will come out, compared to 2, 3, 4 months down the road. We can see, if the vol curve is consistent with a normal vol curve, or there's actually some outsized volatility priced in to this litigation. All right, I'm going to end this with a CME Group trade. So CME was in a class action lawsuit going back 12 years to 2014. It finally come to a head. The class was certified. They went through a ton of litigation, a ton of motion practice back and forth. It finally resulted in July of last year going to a jury trial. The jury trial began, I think it was like July 2nd or July 1st, and it went on for 3 weeks. And this coincided with their second quarter earnings announcements. And so CME had a conference call on July 25th, and they were about to the jury was about to be sequestered on like July 26th. And so they had a conference call in their disclosures, and you can go and dig this up. And in this, the plaintiffs had brought, 2 suits for breach of contract and breach of duty of good faith, or breach of the covenant of good faith, for a total of $1.5 billion, which represented about 4 to 5 months of gross profits. Now, CME in their disclosure, I'm going to show this here, okay? As I have this highlighted, trial commenced on July 7, 2025, and a verdict is expected before the end of July. All fair, all good faith. Um, and while they believe they have a strong factual legal defense of the claims, it's an unlikely event defendants were found to be allowed to try. The company this time is unable to estimate the reasonable possible loss or range of reasonably possible losses, given the uncertainty of factors that may potentially affect the resolution of the matter. So what does that mean? It means they haven't accrued nothing. Nothing's been accrued. Okay. So we have this 4 month or 5 month potential loss of profits. And guess what? We're at a jury trial at state court. That means 12 people, 12 peers in your community, okay, are going to decide this. All right. And the standard is a preponderance of evidence. So this is a multi-billion dollar company with whatever, $80 billion in market cap. And not only are they facing 1.5 billion, but depending on the nature of this case, they're facing equitable relief as well. And by equitable relief, I mean if it was determined that the members in their seats were prejudiced, then the entire revenue model for CME, all right, could possibly be rechanged. Now, it came out in favor of CME, they came back in favor of the defendant 12-0. Well, let me give you a sense when I talk about asymmetry, what I mean. Senior Group was trading at $178 that morning for the jury verdict. When the decision came out, they rallied 50 basis points. 50 basis points, big deal. Like that's the average range. But had they lost and the jury come back in favor of the plaintiffs, you can look at a $25 or $30 down move or share. They would have lost 5 months of revenues and potentially have to restructure their business model. All right. So that's something that really, shows you the asymmetries around this. And it's a feature because these companies, as a practical matter, don't have to accrue a large loss. Now, it doesn't mean that they don't at times, but as a practical matter, in most instances, in my experience, they don't have to accrue a large loss. And that is the rub, and that is the opportunity I would like everyone to take away from today. All right. So best practices. Stay on top of major litigation for stock that you own or when the bellwether. Read the footnotes disclosure. Tools like Pacer, which tracks federal court actions and federal filings, Bloomberg Law. There are other sources out there. Compare options pricing with their normal volatility skews to see if the market is properly priced in the event. And here's a little about me. If you want the deck today, go ahead. John Netto, John at yourlegal.com. I'm the chief legal macro strategist at Rareview Capital, an SEC and registered investment advisor firm. And I'm also run my own law firm, Unit of Risk Legal Advisors. You can go to my webpage, yourlegal.com, to learn more about that. But also, if you want a copy of the deck and the white paper that I wrote a white paper on ASC 450, and we are at the end. Mark, do I have any questions?
Actually, the question that came in, they you had just covered it. They were wondering, they said, excellent, interesting concept. It's new to this viewer, and they were asking if there's a source where they can learn more. So just check out on your screen right there, and that's going to be your best bet.
Amen. Yeah. The white paper, you need a white paper and the deck. You can do that. But I appreciate you guys. And hey, there you go.
All right, John, thank you. One more question rolled in. They were wondering
Yeah.
how did you trade CME last July?
I lost actually. I bought puts on it that day. For the outsized move. Then the puts I got out when I saw the result. Um, paid like 80 cents for the puts, and I sold them for 50, 60. So I lost 20 cents, and I believe in good faith that had it come out the other way, I would have made about 20 bucks. So I risked 20 cents, 25 cents to make potentially $20. So, that's your run of the mill 100-to-1 risk to reward ratio, on a trade like that.
Yeah, absolutely.
But I didn't want to buy it because they didn't accrue. The whole point is they didn't accrue. So that's why it only went up a little bit when the result came out. And that was, you find out that someone that's a Friday that came out on a Friday afternoon, by the way, and that's something the jury can do sometimes. That was a real risk. Is that the jury went to jury was sequestered and started to deliberate at about 9 a.m. that morning, 9 a.m. I believe 9 a.m. Eastern time, and they came back at like 1 p.m. Eastern time. There's always a chance the jury could have deliberated and come out with a decision after going through the weekend. I'm not sure how Illinois state jury works if they'll still keep meeting on the weekend. I think that's probably the jury foreman's call to make. But these are some of the procedural nuances that go state to state, so it's important if you have access or you understand that it definitely helps. But there you go, Mark.
All right, thank you so much, everyone. We're speaking here with John Netto. You're watching Money Show's Virtual Expo, your 2026 portfolio review. John, brilliant presentation. Thanks for taking the time out. All right, everyone, stick around. We have more great content coming your way over the next 2 days. Thank you so much for being here. We'll be right back with you.